An isolated margin trade is a type of margin trading where the margin allocated to a specific position is isolated from the rest of your account balance. In isolated margin trading, each position has its own dedicated margin. This means that the margin for one trade is not shared with other trades. If one position incurs a loss, it won't affect the margin allocated to other positions. By isolating the margin, you can limit the risk to a specific trade. If a position moves against you and the margin falls below the maintenance requirement, only that position will be liquidated. This prevents a domino effect where losses from one trade could impact your entire portfolio. Suppose you have two positions, A and B. Position A has an isolated margin of $1,000 and position B has an isolated margin of $2,000. If position A incurs a loss that exceeds its margin, only position A will be liquidated. Position B remains unaffected because its margin is isolated. Isolated margin allows traders to manage risk more precisely. You can choose to allocate more margin to positions you believe are less risky and less margin to riskier positions. Isolated margin trading is particularly useful for traders who want to manage their risk on a per-trade basis and avoid the potential for one bad trade to affect their entire account.